Well, welcome to Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me, as always, is the great deputy editor of Grant's, Evan Lorenz. And we have something special this morning. We have a transatlantic podcast, not just one of these provincial things, New Yorker to New Yorker, but we have a man from the city of London. And his name is Matthew Earl, and he's managing partner and founder of ShadowFall Capital and Research. And we'll be hearing from Matt in just a moment. But in the meantime, Evan, I had a singular experience. I am speaking to you, ladies and gentlemen. I'm speaking to you from the village of Schoharie in upstate New York, where Patricia, my wife, and I spend about half our time. We're half in New York and half in Schoharie. And this morning I drove, as is my wont, I drove into the Stewart shop, which is the country store nearby, to buy newspapers. That's a generational thing, Evan. I buy newspapers. They're on paper. And I walked into the Stewart shop a little self-consciously because I couldn't find the mask, a stupid, filthy surgical mask, this prop, this theatrical prop of, quote, these difficult times. I couldn't find damn thing. So I walk into the Stewart shop wearing my wife's femme mask with a kind of a gold chain dangling down from it because that's the way she wears it. I felt stupid wearing this thing, extra stupid. I always feel stupid wearing these masks. I walked in, not quite reading the sign on the door. The sign, as I later discovered, said, in effect, no mask required, because we've gotten over that, much to my delight subsequently. But in the meantime, I'm walking in, not only wearing a stupid mask, but also wearing a feminized one, and I'm a little self-conscious at the age of 74 and 7/8. One wants to keep up appearances. But I noticed that the funny thing about the crowd in the store, nobody was wearing a mask. So deliverance. Evan, deliverance. We are making progress.
Nice to hear we're making progress on one thing.
Well, progress in many things. I think it's progress in the rate of inflation. It's higher. Progress in the Fed's balance sheet. That's fatter. Progress in the size of the reverse repo facility, that polysyllabic thing, which, Evan, as you know, signifies the following. It signifies a man named J. Powell playing a fire hose into an overflowing storm drain. That's what a reverse repo facility is when there is too much money in the banking system and not enough assets in real life. The banks put this money back to the Fed on overnight hire or weekly hire, so-called reverse repurchase agreement. And it's so chock-a-block full of the banking system as redundant funds that the Fed must take these back again and lend in exchange, mortgage-backed securities, treasury, what have you. So this is where we've come to. I mean, Evan, you've been all over the story about the diminishing returns to QE, but my goodness, they buy $120 billion a month, and they're surprised when there is too much liquidity around.
So to borrow from Bernanke, you're saying there's green shoots.
No, I'm saying it's waist deep. So Matthew Earl is our guest today, and he's managing partner and founder of ShadowFall Capital and Research. Research is not the only thing they do. They manage money, selling high and buying low sometimes. And Matthew brings to the table a Master of Mathematics degree from the University of St. Andrews. And he's had a sell-side career and now an entrepreneurial career. He has invested, he is investing, and he knows all sorts of stuff. So, Matthew, welcome.
Thank you very much. Thank you for inviting me.
And I wanted to begin by asking you of what utility is an education in mathematics in this day and age, seemingly, of MEM investing and I don't know. The arithmetic doesn't seem to work as it once did in the realm of investing, or is that a misconception?
No, I begrudgingly agree with you. I think it's certainly a diminishing skill set in terms of its applicability. I think when I started off, it served me quite well in that fundamentally what I always enjoyed with mathematics was that there was certainly a logical element to it, and there was quite an elegant way of proving things. You can prove things in various manners, but ultimately you can get to the crux of the matter and have a solution and an answer, whereas I think these days it doesn't necessarily count as much. I mean, one of the strongest proofs that I always used to lean on was proof by contradiction, which I found incredibly applicable to company or rhetoric from company management, which was that you give them essentially the benefit of the doubt in terms of what they're telling you. But if you were to find an instance which would contradict that, i.e. that they were telling you a porky, then that would question the veracity of what they've told you historically or on other occasions.
I think I've heard a new noun. They are telling you a porky?
A porky, yes, a fib or a lie, essentially. It's a polite phrase for a lie. It comes from porky pie.
Well, we have super abundant pork here. Evan, can you think of instances in which we ourselves have been fed pork?
Oh, all the time. I mean, pick up just any kind of SPAC merger presentation. They'll tell you that the company is going to go from $0 in revenue this year to $5 billion in 2025. I've read basically 100 of these, and they all have the same plot line. 0 revenues now, but $2 billion, $5 billion in 5 years now. And it's like financial fan fiction.
Yeah. So, Matt, tell us to begin with, if you would please, what is the state of play in London and on the continent with respect to the fine art of short selling? I know that you've done other things in your life. I know that you're not dedicating entirely to this business of uncovering fraud and deriving what we call in the trade a little pompously, I must say, alpha. That is to say, making money from things that are mispriced to the upside. What is the state of speculative effervescence? What is the set of opportunities in the markets in which you deal? Is it are the opportunities more compelling on the long side or the short side?
I think on the short side, there's more opportunity than ever. The problem is trying to determine what presents those best opportunities out of that set that's available and what people necessarily care about in this environment. I mean, there are things that I think people may have deeply cared about 2 or 3 years ago. They don't necessarily get too fussed about these days. I think it's not necessarily that the opportunities aren't there. It's just trying to work out what inflicts people's switches, essentially. So I would say that increasingly so there's a greater focus on ESG approaches to investing, and where you've got instances where perhaps companies aren't towing the line of an ESG approach as much as their investors think they might be, then that can have issues further down the line. But it's always difficult. I mean, I've never known it more difficult than it is in this current environment. I've been doing it for about 10 years or so, short selling.
Yeah. It seems like there's two groups that kind of doubt bad news, and one is investors themselves, but the other is the regulators. And you were one of the first voices on Wirecard to actually bring up issues in that. And I believe that Wirecard didn't actually get its comeuppance until mid last year. How do you deal with kind of the double fact that investors don't seem to actually read the reports themselves and don't seem to care about what seem like seemingly glaring bad news, and the regulators themselves seem to brush it under the rug or even buy shares in the companies themselves? Yeah,
I mean, I think the investor base is still probably as credulous as it's ever been, if not perhaps more so, just generally across Europe. Obviously, that doesn't apply to everyone, but what's been fascinating over the past year is that I think on the short side across the pond over in the US, the short activists or short sellers have had a bit of a tough time, whereas actually I say we live in a post-Wirecard era now in Europe, where there are some glimmers of hope in terms of the approach to heeding the warnings from short sellers or whistleblowers. So put things into context, I mean, Wirecard was probably the most obvious fraud in Europe for at least a decade. It's just that any time that any critic of the company, whether it was a whistleblower or a short seller or a journalist, decided to try and raise awareness of the issues of the company, the investor base just blithely ignored it. The investment bank analysts just came to the rallying defense of the company and wrote their perfunctory buy recommendations and lofty target prices. But I think more damningly, or what made it more difficult, was that from a regulatory perspective, the German regulator, BaFin, they actually actively pursued the critics of the company and sought to essentially prosecute them, again, whether they were short sellers or journalists, for what they classed to be market manipulation. They didn't give any view that what was being said about the company may actually be accurate, which obviously, it turns out that it was entirely accurate, hence the collapse of Wirecard in June last year. So what you've seen over the past year is, I think, a lot of introspection, certainly in Germany, where you might expect it to be felt most, where there has been repercussions in terms of the regulatory level, where the president of BaFin, or the former president of BaFin, Felix Hufeld, had to resign, as did his underling, the vice president. And you're also seeing that with some of the kind of so-called enablers of these sorts of instances, people, firms like the audit firms, where EY audited Wirecard for over a decade. Again, they didn't pay any attention to the warnings that were given, and they're now paying dearly for the reputational damage of having been associated with it. Most recently this week, where I think it was the FT reported that Deutsche Bank have decided to tender out for the audit amongst the other big four rather than EY again. When
you feel the back of the hand of Deutsche Bank, you have felt scorn.
Yes. Yeah, even if Deutsche are going to talk to you, you've really hit hard times, I guess.
Hey, Matthew, you had early in your career, you had one of these formative experiences, one of the kind of experiences that to a person just starting out in a career can lead you in a certain direction. So there was a stock called Chanos PLC, and everyone loved it, and you saw something that others didn't, and you issued a bearish analysis of Chanos. Did you say Chanos? Or you of all people know how to pronounce this thing.
Chanos, yes, yeah.
Yeah. And within 6 months it was broke. So that, first of all, must have been most inspiriting and encouraging. But do you ever wish that you had never done that and instead had fallen in with the kind of the 72-degree Fahrenheit room temperature crowd that just buys indices and goes home on the weekends without anxiety, and that seems to do rather well in life? The short selling business, it's a hard way to make a living. Have you ever had second thoughts about it?
Well, I did at the time, leading up before it actually collapsed and went spectacularly bust, because it was pretty stressful. Certainly not as stressful as the whole Wirecard saga, but it was at least a good, I guess, grounding for what was to come with Wirecard later. At the time, this was a company that, it wasn't particularly an enormous company in terms of market value. I think it was about 700 million sterling market value, but it was widely loved by sell side and most of the pension funds and institutions over here, because it was a relatively steady performer. The honest truth is that I kind of stumbled into it because I just looked at it, I guess, with a fresh pair of eyes and thought, well, a lot of the things with this company don't really make much sense in terms of the capitalization policy, where they suddenly embarked on a significant spending spree, buying, investing in software development. Well, what this company did was repair social housing, fixing light bulbs and broken doors and installing bathrooms. So quite why they needed to spend huge amounts on software, I wasn't sure. And so there were other aspects like that didn't really make much sense. I rather naively, I guess, being younger at the time, and slightly green, put out a sell recommendation, and as you might expect, it wasn't taken too well by the management nor the proponents of the company. So management wrote emails saying that they said I performed a masterful feat of incompetence, that I was a mediocre analyst, I got my numbers completely wrong, which I had, because in the event I was far too optimistic. But this lasted for about 5 or 6 months. I switched firms as well at the time. I was headhunted to go elsewhere, and of course, as soon as they caught wind of that, they spread the rumour that I'd been fired for incompetence. And then, after a month or so, when I pitched up at this new shop, they revealed that they were a glorious fraud and that they'd hidden, I think it was about 100 million or 200 million of debt under the carpet.
Did they ever say sorry to you?
Oh, no. This is the other thing. Nothing ever really came of it in terms of any repercussions for the management. I think they sold a fair amount of stock in the run-up to the downfall of the company, certainly the year prior to it, and they made off like bandits. The CFO of the company, I think the last I heard, he launched a restaurant in Devon or somewhere on the southwest coast. So I said he went from cooking the books at Connaught to just general using cooking books.
We were talking with Matthew Earl, who is managing partner and founder of Shortfall. Shortfall, ShadowFall Capital and Research in London. And Matt, as you have been gathering, ShadowFall is a specialist in the fine art of selling high and buying low. And Matthew, tell me, I am not some journo from across the pond, but I'm a substantial citizen in the UK, and I come to you with 5 million quid, and I say, Matthew, I do not like the cut of the jib of this market one bit. I would like you to make these 5 million quid prodigious by implementing short sales. Now, how would you go about investing a new increment of investable funds? Specifically, would you hedge out market risk? Would you not hedge? Would you invest immediately? Would you bide your time? Tell us how you actually do this thing of short selling.
Yeah, so we essentially have two offerings. One, we have direct investment into the ShadowFall Fund, which is actually a market-neutral fund. So within the fund, we manage a concentrated short book, which is typically around 10 positions. We don't use any gearing in that we're not lunatics on the leverage side of things, which is incredibly dangerous with short selling anyway. But what we do is we manage roughly around 10 positions. We allocate the capital. Obviously, they'll have different weightings in the book. And then we hedge out the beta risk by buying the equivalent beta weighting on the stock 600, or the Euro stock 600, I should add. And then we recalibrate that hedging instrument on a daily basis, essentially, to take into account market movements. So what we're trying to do is fundamentally beat the market, but on the short side, and to generate short alpha. And so that's what we offer in the fund. And then we also offer the ability to do so-called SMAs, or managed accounts, where either they fully replicate that fund structure, or some instances it might be that the ultimate investor just purely wants the short exposure because they're naturally long elsewhere, and they use us to essentially try to generate short alpha versus hedging out their long exposure.
Yeah. Where are you finding the most promising or compelling short ideas, on the continent of Europe or in the UK?
I guess probably 40% of our book is typically UK exposed. It fluctuates a bit, but generally it's more UK. I'd argue that's probably two main reasons. One is because obviously there is that language barrier, where we dig down into the weeds with subsidiary filings. If it's a European issuer, obviously the top co is going to be publishing in English, but the quality of data at the subsidiary level, if you're looking into kind of French subsidiaries or Belgian or Lux subsidiaries, one, the quality of the data is not particularly great sometimes, and two, then you also have that language barrier where you can translate it, but it's quite time consuming to do so. And then the other instance being that I think historically the UK investment scene has been a little bit more akin to that of the US market, in terms of more open-minded and perhaps more willing to actually appreciate that there may be a bear argument on the company, rather than, I think, some kind of long-only European institutions which are a bit reluctant to actually acknowledge that there may be question marks over what they may have invested into.
Although I'd say right now, short selling is at multi-decade low in the U.S., and we have a retail Ford who's trying to harangue short sellers. So maybe the sentiment has changed some. Do you do any short selling in the U.S.?
Yeah. No, we don't. No, I mean, we only focus on UK and continental Europe. I think the US is pretty well covered. Obviously, there's quite a few short activists over in the US. I mean, I say short activists. I class us as a short activist, but with a very small a, in that we don't go active on everything that we research into or that goes into the fund. We just put our head above the parapet every now and again, where we generally think that there's a pretty strong public interest element to the investment case. But no, we focus on UK and continental Europe. And we only look at companies typically over $1 billion in market value as well, because ultimately we want to make sure that the ideas are actionable, and that we take into account risk across the board, whether it's personal risk, obviously in the light of the experience of Wirecard, or in terms of trade risk as well, because we want to make sure that we've got sufficient liquidity, and that there's things like the trades aren't too crowded, that there's plenty of borrow available, that the cost of borrow isn't prohibitively expensive as well. So generally, we find that easier to accommodate when you're looking at issuers that are over €1 billion in market value.
We were talking with Matthew Earl, who's managing partner and the founder of ShadowFall Capital and Research. Matthew, I wanted to ask you about Wirecard, which you were one of the original discoverers of the fraud there. And tell me how the persistence of that fraud plays into the doctrine of efficient markets.
Well, I mean, unfortunately, it severely undermines it. The issues with Wirecard were raised by numerous people. I mean, obviously, the Financial Times journalist there, Dan McCrum, he'd been writing on the company and raising issues with the company since I think it was 2014 or 2015. Prior to that, there'd been, I think it was 2007 or 2008, there was at their AGM, someone had popped up at the AGM and took management to task for falsifying the accounts at that stage in time. So this was a pretty well-known, obvious fraud, but it sort of became a parody of itself in a way, I would argue, in that the more that it was alleged against it, and the easier it found, or the more it could deflect that, and it became Teflon-like. I guess a lot of the investors in it took encouragement from that and decided that either, one, there could be nothing untoward with the company, because given everything that had been alleged against it, you would have thought that the regulator or legal authorities would have stepped in to query that and to investigate it. Or this thing's absolutely bulletproof, until obviously it's not. So, yeah, I mean, this was very widely known. Obviously, the issue was, more latterly over, I guess, the last 4 or 5 years of its lifetime, was that I imagine that management thought at some point they will really have run out of road, and they were pushing their luck. And so they became very aggressive against critics of the company by placing critics under surveillance, trying to discredit them by releasing kind of so-called doxing documents on the internet to discredit any critic of the company, or possibly commissioning firms to target the critics with sophisticated cyber hacking attempts as well, or legal pressure as well. I mean, I received, December 2016, a very threatening legal letter from Wirecard's lawyers accusing me of everything under the sun. It was market manipulation, conspiracy, collusion, everything apart from murder, I think it was.
So what happened to that law firm?
Well, I think they stopped acting for Wirecard after a time. I mean, what was frustrating was that my lawyers, obviously, who I use, they said, well, they don't really have a leg to stand on, because if they did, then they'd be able to articulate what it is exactly they were claiming. So, for example, if they would claim defamation, we would respond to say, well, that's all well and good, but could you specify what exactly has been defamatory about what the research that has been put out? Now, of course, they couldn't specify what was defamatory because it was true. So if you do wish to proceed to court, then that's quite a fundamental flaw in your ability to do so. Because as soon as you get in front of a judge, the judge is going to say, right, what are we here for? Okay, it's a defamation case. What's the defamation? And if you can't determine that, then you don't have a legal claim.
Now, let me ask you this. Was Wirecard for you, for ShadowFall, was it a profitable transaction after all this? After all the legal costs, after all the aggravation? Was it a moneymaker?
It was. Yeah, it was. I stopped trading it in... I made money in 2016, and then thereafter I didn't, because I tried to raise awareness publicly throughout 2016, and then when that wasn't working, then I started kind of a private battle against the company by, eventually going all over the world to try and raise awareness. So I met with the London Metropolitan Police. I spoke to the FCA here in the UK. I tried to reach out to BaFin, but that was a complete deaf ear to any ability to listen to what I was saying. I ended up going to see the Munich public prosecutor in Germany to present evidence to them. I even saw the FBI and the Department of Justice in St. Andrews Plaza in New York. So the problem was at that point in time, because I was kind of, this was all non-public, it didn't feel appropriate having those conversations to be trading in the company.
No, I told you know Jim Chanos, don't you? I'm sure you know of him.
I don't know. Oh, I know of him, of course. Yes.
Yeah, of course. Yeah, New York's famous American short seller.
A legend. Yes.
Yes, and I told Jim that you actually are an investigative journalist Monkey. That if journalism paid as little as $25 million a year, you would be writing for the New York Times rather than. Now, do you?
Yeah. Absolutely. I mean, because you'd have you'd have a bit more protection, I would imagine, because you'd have a bigger team around you, and
and a dental plan, and all the other amenities of corporate life. Yeah. So it finally or semi-finally, Matthew Earl, founder of ShadowFall Capital and Research. What's the next Wirecard? And then now, wait. If you're uncomfortable telling us the name or the ticker, you can just send it to Evan, and we will put it in grants. And our readers are so discreet that only they will know. All right. So what's the next Wirecard?
Oh, I hope there is not another Wirecard in terms of all the trials and tribulations of it. Of course, that doesn't mean that there's not another fraud out there. But I hope that Wirecard is a complete once-in-a-lifetime event. There's lots of companies right now where there's a lot of things that don't make much sense. I think you guys actually wrote up a very good piece on this company some years back now called Kerry Group in Ireland, which is a food ingredients business where this is a very acquisitive company. We're shorted, by the way, I should add, just for full disclosure. But this is about a 20 billion euro market value company listed in London and Ireland. It has two parts of its business, consumer foods and food ingredients. And it's largely grown by acquisition. And the issue we have with the company is, one, it doesn't really give much away in terms of what it's acquiring, in terms of financial metrics. But where it is available, then we can't really make the numbers add up. So we're pretty bearish on that company.
Yeah, it was Evan's good work. Yeah.
And just in terms of their disclosure, it's not just the acquisitions. I remember going through their financial reports, and it's hard to understand exactly what they do and how profitable they are. Their disclosure was not good.
No, absolutely. I mean, and it doesn't really make much sense either in terms of the reasons they provide as to why their disclosure is limited. So, for example, I think recently they were asked about it, and they said, we're buying companies we're making acquisitions off of small family businesses that don't really wish to have much disclosure, which it certainly wasn't the case with some of the big acquisitions they've made over recent years, where I think one of the businesses they bought was a vinegar company called Fleischmann's Vinegar, which they bought off of Green Plains, which is a US-listed company. And Green Plains actually gave more disclosure than Kerry. So these sorts of arguments don't really stack up. And then you have to, one wonders why they're being so reluctant to provide much information around these things.
I know.
But
I know why. You can read about that in grants. But before we wind up, we have Evan. I forgot the commercial. So let's see. Subscribe to Grants, Interest Rate Observer, and invest with ShadowFall Capital and Research. That's simple, right? To the point.
Works for me.
Okay. Yeah. Okay. Matthew Earl, it has been a delightful experience talking with you. Thanks for bringing us up to date on the selling high and buying low business in London and the continent of Europe. And we will talk to you again soon, I hope. And Evan, good to catch up with you, comrade. And just keep on not wearing that mask. It's my advice.
Thank you, Jim. Thank you, Evan. It's been a pleasure to talk to you. Thank you.
Yes, happy weekend to you, Matthew, and to our listeners. I guess the weekend will have been over. But in any case, enjoy the next weekend. Until next time, this is Jim Grant on behalf of Grant's Interest Rate Observer.